Good afternoon, and crazy markets we're experiencing this week. And this is a nice little break to get away from all that madness. And for those that don't know me, my name is Michael Valtos. I'm the founder and trader at Order Flows. And today I'll be talking about my favorite order flow trading methods. There's many different ways to approach the market, and especially with order flow, there are many different ways you can read what's happening in the market. So today, I'm going to show you the easiest way to understand what's happening in the market so you can make better trading decisions tomorrow by adding order flow analysis to your existing method of trading. Now, what's great about order flow is even if you have been trading for a while and you have some measure of success, if you can add order flow to it, it can actually help improve your trading results. It can help you refine your entries, refine your exits, and get more out of moves that you're in. So my goal for you today is just 4 things I'll be covering. It's reading the order flow chart, how to use the order flow tools to support trading decisions, using order flow to control your risk, and I'm talking about there's more to trading than just having a successful strategy. A lot of people come to the markets thinking that if they just buy a trading system, they'll have success with it. But unfortunately, as most people realize quickly, is there's no sure thing in trading, and it takes actually more than just having a trading system to be successful in the markets. And if you stick around to the end, I got a special gift for you. It's my 150-page book that I wrote a few years ago called Trading Order Flow, which takes a lot of my experience and knowledge that I've gained over the years trading professionally, and I've put it all down on paper so that everyone can understand how the people on the bank side, on the commercial side of trading, approach the markets. So, ask yourself, are you a trader or are you a trade follower? And what's the difference is, do you make trading decisions based on what you see in the markets, what's happening in the markets, or are you just purely following a trading indicator and buying because it's turned blue, or selling because the line's turned red, or you cross the zero mark? That's not trading. That's just being a trade follower. It's I work with a lot of traders that are struggling in their trading, and I ask them how they trade. They say, well, they follow this indicator. Okay, I ask them, can you explain that indicator to me? Well, if it gets here, it says it's overbought. Yeah, but what goes into that number that tells you it's overbought? And they can't explain it because they're not traders, they're just trade followers. And with order flow, and what I'm going to do today is to teach you how to trade as a trader. So for those that are new to me, my name is Michael Valtos, and I've been on the professional trading side. I hate to call it professional trading side, but I spent 8 years at JP Morgan as vice president of futures trading. I would come in, that's all I did for 8 years. I would stare at the market, stare at the screens, and trade all day long from in the evening. And before that, I was with Cargill, which is the big commodity trading firm. I even set up a futures trading desk for them in Singapore. I did that for 4 years. Before that, I was with Commerzbank, the big German bank, for 3 years. I was a Eurex trader. I traded Bunds, Bobbles, Schatz, DAX, and anything on Eurex. Before that, I was with EDF Man for a couple of years. EDF Man is the big English trading commodity trading firm. It got their start in sugar in the 1700s, and they're big in physical commodities. And before that, I started on the CME trading floor as a runner. I literally started at the bottom. And you can't do that nowadays because there are no trading floors. It's very difficult to get into trading these days unless you go to a certain school, you have a certain background, and you know computer programming basically. Most people won't even interview you unless you do that. And that's why I like to do these presentations with Investor Inspiration, is because I like to share my knowledge, because this is knowledge that nowadays is very hard to get because you don't have access to traders. A lot of traders won't give you the time of day. People have been trading professionally are generally very closed people, and that's why I like to do this, so I could get this knowledge out to people and they could use it in their trading. I'm not saying you have to do everything I say, but hopefully there'll be something that resonates with you that you can use in your trading. In 2013, I left JP Morgan, spend more time with my family. That's the beauty of trading. It gives you the freedom to do what you want to do with your life. And I started writing my book on trading order flow, and I was trading as well. I said I've been trading since the 90s, and you just don't walk away. I still need to follow the markets, and I was still trading with order flow, but I was using a volume footprint chart, and at that time in the 2013, 2012, 2013, 14, you said your basic volume footprint charts. There's not much has changed since then, but I realized that, with computers can do a lot of the heavy lifting for you. And things that I look for in the order flow that tell me if there's price support, price rejection, absorption, if there's a way I could put that into, into some sort of coding and programming that can highlight those areas to me, then it would free me up to look at other market nuances in the order flow. So I created the order flows trader software to take the order flow volume footprint chart to the next level, to tell me when there's price rejection, tell me when there's price support, absorption, and other things. And it runs on NinjaTrader, runs on NinjaTrader 7 and NinjaTrader 8. We actually have a Sierra Charts version. Next week, actually, with Investor Inspiration, I think my friend will be doing a presentation on that. But again, I don't want to talk about myself too much. I just want you to understand my background and where I'm coming from and what I like to think qualifies me to talk about this. It's not like I traded part-time in my basement. No, this is what I did for a living. This is how I paid for my house, paid for my car, everything. This is how I survived in life for 20 years. And you don't become successful, you don't last that long at trading firms unless you're a halfway decent trader. And so I want to show you how order flow analysis can help you in your trading as quickly as possible. I want you to get from point A to point B fast. I don't want you to waste your time, because life's too short. People, I talk to traders sometimes and they're like, well, I've been in sim for the last 2 years. My goodness, I can't imagine that. At some point you got to, put money on the line and trade. There's a big difference between trading in sim and not. Decision-making process is completely different. So let me be clear, right? In trading, you have to make decisions. That's what trading is about. Order flow is not a red light, green light trading system, but when you understand order flow, you understand the market, and decisions will become crystal clear. It's like driving a car. Once you internalize the basics of driving a car, over time, as you drive more and more, you become a much, much better driver. So, but before we begin, a brief disclaimer. This is not a picture of my lawyer, but this is my favorite lawyer. And this presentation is for educational and informational purposes only. It should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Especially in these markets this last week with the volatility at these very, very high levels. Most traders haven't experienced these levels. These are levels that we haven't seen for about 10 years, since the financial crisis. VIX the other day got up to above 50, I believe, and it's the first time, in a decade. So for people that haven't been trading that long, this is new territory, and especially we're coming up off of kind of low volatility as well, and it just ramped up really quick. But over the years, the last few years, I've been working with a lot of retail traders and finding out why they fail and how they can improve. And three main reasons that I've come to the conclusion, that there's sort of a common denominator among traders that are struggling is: one, they don't understand the market; two, they take on too much risk; and three, they spend too much time learning and not enough time doing it. And what I'm talking about that is, spending years in sim. At some point, it's fine to practice, but at some point, you got to put money on the line and learn how to trade, with real money. And again, number two, taking on too much risk. Literally, the other day, Monday, I was talking to somebody after Monday. He asked me how I did. I lost $800 in like 2 minutes on a series of trades, and that told me I didn't know what the VIX was doing. $800 is not a lot of money, but for me, I know that the way I trade, this is suffer those quick losses just like that. Literally after I buy, I get stopped out. I know that there's markets are too volatile, and there's two things you could do. One, you could reduce your size, or two, you can stop trading. I chose to stop trading. Normally I would just reduce my size, but the way the market was moving, I said I can't. I just need to stop and let this market calm down. Then over the next couple of days, we had those wild swings, and that comes down to number one, not understanding the market. you have to understand when the market is moving fast, when it's not moving fast, when it's more volatile than not. And once you understand that, when you understand order flow, then you'll understand the market and when it's moving too fast. So order flow, what's the benefits of order flow? Well, it makes it easy to find hidden strength and weakness in the market, determine if highs or lows may hold, see market generated support and resistance levels, determine if price is being rejected, and there's other things, but these are the four main ones. And again, this knowledge, this information is not available on a normal bar or candlestick chart. So this is your normal candlestick chart, and most everyone has seen candlestick charts. I mean, they really became popular in the 90s. And I used to be a big candlestick guy, all these different patterns I used to have memorized and look for certain ones. But when they worked great. When they didn't work, they didn't work. Unfortunately, it was just like anything else in trading. But when I first started looking at order flows charts in the 2000s, then it really opened my eyes to what was happening, because basically it took the time and sales, it took what I was seeing being traded, and it put it into an easy to read format. And so I was able to learn and see where there was supportive buying coming into the market, where there was resistance selling, where there was price acceptance, where there was price rejection, whereas you just can't see that information on your normal candlestick chart at all. So first thing I'll talk about is reading the order flow chart. And for most people, when the first time they look at an order flow volume footprint chart, they're a little bit confused. And I don't want to say intimidated, but when people see numbers, it's, for some people, it's a big turnoff. And I'll be the first to admit I did not like math in school, and so dealing with numbers, if I can't do it in my head or do it on a calculator, I kind of lose my patience. But it's not like that. With order flow, you're just looking for certain inflection points in the market, and there are three main things of order flow that you really need to concentrate on. It's sort of your building blocks, and that's the point of control, the delta, and market imbalances. And all that information is there available on any footprint chart, whether it's mine or whether it's another company's. Run through them. A point of control is the price level in a bar with the most volume, which in each bar you have a point of control, and you can see it's usually got a rectangle around it. Okay, and that's just simple. It's just the price level in a bar with the most volume. Second is delta, which is the net aggressive buyers or sellers in a bar. And delta, on most software, it runs along the bottom line. Some put it above or below the bar. But what it is there's a number. There's a headline number. So like you'll see here, it's green, it says 65. And that tells me there was 65 net more aggressive buyers than aggressive sellers in the bar. And what's an aggressive buyer or an aggressive seller? Aggressive buyer, market's a two-way auction. Okay, so you have a bid, you have an offer. The market is 5 bid at 6. Say I'm bidding 5 and my wife is offered at 6. Unless one of us moves their price, either me go up or her moves her price down and becomes aggressive, no trades will happen. But if I'm going to be aggressive, I think the market's going to go higher, I'm going to move my bid from 5 up to 6. I'll be the aggressive trader. I'll be the aggressive buyer because I'm buying, so I buy her offer. So I'm being aggressive. If she thinks the market's going down, doesn't want to wait, doesn't think that I'm going to move my price, she will become aggressive and sell at my bid at 5. So she is the aggressive seller. And when you take those differences, you either have net aggressive buying or net aggressive selling. Occasionally it does come on 0, but that's just more coincidence than not. And again, people always say, well, why did the market go up? Well, you have more buyers than sellers. No, the reason markets go up or down is because you have more aggressive buyers. That's what makes the market go up. Markets go down is you have more aggressive sellers. Remember, it's a zero-sum game. For every buyer, there's a seller, but you'll have more aggressive traders. In an imbalance is the net when you have more aggressive buyers than sellers, or more aggressive sellers than buyers in the auction by at least 4 to 1, and it'll show up in a bar as either aggressive buying as a blue number inside the bar, or a red number if it's aggressive selling. So as you can see here on this red bar, you have 31 against 145. Remember, the market's a two-way auction. So 145 sold into the bid versus 31 bought on the offer. That's 145 is more than 4 to 1 times the 31. That's why it's red. So that's you have aggressive selling. You have aggressive sellers selling into that bid. Just as you have a blue number here, 1 against 69, you have aggressive buyers buying the 69. Sorry, you have an imbalance of buyers buying these the 69 lots, 1 against 69. That's what an imbalance is. Now, taking it a step further, so like I said, those are the building blocks that you need to know with trading order flow. So when I launched Order Flows Trader, one of the things I wanted to do is I wanted the software to analyze the order flow for me. And I came up with what I call the ratios, and ratios will help me determine if price levels are being rejected or defended. And there's two types of ratios. There's a ratio bounds high, which indicates price being rejected. There's a ratio bounds low, which indicates prices being defended. Okay, and how does that look on an order flow chart? It appears, if it's a down bar, a red candle, it'll appear above, because when the market's selling off, you should be looking at signs. Why is it selling off? Is there price rejection up at these high levels or price resistance? Now, on up bars, on green candles, they'll appear below. And there's two types of ratios. There are two colors, rather. There are blue ratios, which are the ratios where it's something to note. It's either going to be a ratio bounds high or a ratio bounds low, and that's important. Please take note of those. If it's a black number, as you see here, black, 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 that just means that's your normal order flow, right? Markets exist to facilitate trade. And so not every bar is going to have something that's actionable, something that's tradable. And really what you want to be looking at are for ratios at, turning points in the market, swing highs, swing lows, highs of days, lows of days. As you're starting to move off of highs or move off lows, you're really going to be looking for shifts in supply and demand or price rejection. So here's a perfect example. And you start putting these things together. So here we have the high of the day, right? This green line is the high of the day. You're going up there, boom, you got high, you've got a red candle. So the ratio's on top, it's 35. It's blue color. So it tells you that there's potential price rejection up there. Okay, now you start looking into the order flow and you see you have a selling imbalance here, 30 against 5. Then you got two more selling imbalances at the bottom, 48 against 0, 32 against 0. Okay, so one, you have price rejection. Two, you have selling imbalances. Now, maybe you're not convinced yet. You say, yeah, maybe, we just hit a high, we're gonna come off this next bar or two and start going up. So you're gonna start looking at the next bar after the high. So, okay, it's also a red candle. Now notice the point of control on the bar on the high, sort of in the middle. Next bar, point of control is lower, so it's telling me that the value area of the bar, the point where the most volume is being traded, that's the value area for the bar, is lower. So we're already migrating lower in terms of value. And what happens is you rally in this bar, it rallies back up one tick past that point of control, the previous point of control. Now on a market that's moving down, right, what you want to look for, point of controls, watch them. One, you want them to be lower, and two, you want them to be holding as resistance. Okay, so say, yeah, okay, it looks like we're going lower. You got a potential high. Next bar, okay, it looks like it's going lower, but then by this bar here, okay, the third bar after the high has been made here is a lower point of control. Again, you got it selling imbalance in there. You rally back up, you're one tick off the point of control. So you know that point of controls, the value areas are moving lower per bar. Your point of controls are acting as resistance. By now you should be thinking, you should be short already. Even if you're not convinced, even in the next bar, you've got, another ratio. This one is telling you that there's some selling up in here, resistance selling, and you just keep going lower. You could look at the delta. It's all negative delta, so it's telling you up at this high. You have a high here with positive delta of 52. Okay, it's kind of small, but it's surrounded by bars with negative delta, minus 370, minus 80, minus. So it's telling you that sellers are in control of this market. So there's a lot of things in here that's telling you, hey, this high can hold. You should be thinking of getting short. Now the next one is, again, this is a swing high. It's kind of similar. Again, you're sort of rallying up here. Nice move up. Look at these point of controls, all higher. you know, and they're holding for the most part as resistance on the move up. Then you get to this one bar right up here, and you've got a ratio. You've got, you know, it's indicating some price rejection up in here. And what do you got? You got point of control down here at the bottom. You know, it's a red candle. We poked up there. You know, some people will say, oh, it's a shooting star, you know, candlestick people. But then you look at the next bar, point of control right at that same level, and you start heading lower, okay? You pop back up. Where do you pop back up to? You pop back up towards that point of control, and then you make them move down. So, you know, once you start putting these pieces together, you know, understanding what's happening in the market really becomes second nature. You could almost anticipate, I don't want to say anticipate, but you know, in your head, you can go through the scenarios of, okay, this is what's happening. This is what I think is going to be happening next. And as it unfolds, then, you know, you can make smarter trading decisions. So again, you know, watch them at swing lows, you know, just as I say, swing highs, swing lows. So you got this market sort of bouncing around. Here's a swing low down here. You got a bullish ratio, 44. Here, the next, you know, double bottom, it's not a bullish ratio. It's just your normal order flow, 2.893. So it's nothing special about this second low, but then the bar afterwards, you've got another sign of price rejection. So you know, first time you hit that low, boom, price is rejected. Second time, you know, nothing, no clear sign. But then as you start moving higher and it comes down to test those lows again, you're seeing signs of price rejection. And what did I just say about the point of controls, right? If you're expecting this low to hold, these point of controls should hold also. And you can see how it comes down right to the tick. 2 ticks away, right to the tick, 1 tick away, 1 tick away, and you just make you move higher points of controls. You know, it's almost like Jack and the Beanstalk. You know, if someone says, hey, I got these magic beans that'll tell you where in the next bar, you know, you could have support or resistance, you know, would you be interested? Yeah, I'd hope you'd be interested in that. And, you know, that's just information that's available on the order flow chart. Just, you know, quick visual. Again, you know, if you say, you know, even if you have some other trading method, you know, you're trading with, I don't know, Bollinger Bands, right? And this is you're hitting the bottom Bollinger Band here, and you're thinking, okay, I think we're going to, you know, we're primed for a rally. And, you know, then you start seeing, you know, we're holding these points of controls. Okay, you know, that's a great reason to stay, you know, get in the trade and say, you know, you had a reason to buy down here and you have a target up here, but then you start seeing how it's holding these point of controls nicely, and you see the buying imbalances. You know, you might want to back off of your take profit, you know, give it a little bit more, you know, maybe get an extra point out of it, an extra 1.5 or 2 points. You know, you can read the order flow. I mean, you know, this market's picking up a head of steam, right? So you can probably squeeze more out of the trade. Again, you know, very similar. You know, we just come down into a swing low, and we sort of come down into this bottoming area, right? I mean, you know, when planes land, they just don't come down at a direct 45-degree angle. They sort of come down, you know, then they start taking off again, and the same sort of thing. You know, we sort of come down into this bottoming thing. You know, you got price rejection, then you got 4 point controls right at the same level. So you know you've got some, you got a new extended value area. You know, people are happy to trade, you know, over this time period around this price. Okay, so you know you got some support there. And then you start ticking up, and what do you got? Again, you're right off the low. You got a sign of price rejection. Then the next bar, you got a higher point of control. You've got a bullish ratio. This time there's ratio bounce low, which tells you there's supportive buying coming into the market. And then as you go higher, point of control higher, you're holding this previous point of control. You have a ratio bounce high indicating price rejection as well. And you know, you start rallying. And you know, even if you're looking at the delta, right? Again, you know, I talked about delta earlier, difference between net aggressive sellers and net aggressive buyers. You're coming down into the lows. Look at that. You got strong selling, minus 1,200. Aggressive sellers, minus 1129, minus 431. You have aggressive selling, but the aggressive selling is kind of weakening. It's gone from minus 1,200, minus 1,100, minus 431. Now it's on the low. You got positive delta. You have net aggressive buyers. Next bar, still net aggressive buyers. A little bit more actually. It went from 233 to 249. And then here, 562. So you're sort of coming down in here. Selling is getting weaker. Net aggressive selling. You hit the low. Aggressive buying is getting stronger. Again, you know, this is the information that you can get off the order flow chart. That's, you know, it's available to everyone, and most people don't use it. and most people don't know what to look for. So, hopefully by now you should be getting an idea of how you could add order flow to your trading. And again, I used to calculate all of these ratios things in my head or on a calculator in the past, but one of the reasons why I created the order flows trader was to let the computer do some of this analysis for me, so I can look at other nuances in the order flow. And I've always believed that trading around ratios gives you low risk trading opportunities, which is what you want as a trader, right? You don't want to be taking risky trades. You want to be taking trades that make sense to you, that you can understand. Now, number two, I'm talking about order flow tools to support your trading decision. And again, it's all about understanding the order flow and how you can add it to your trading. So here, we come down into the low, markets are selling off. You come down into the low, you got a sign of price rejection, at a swing low, okay? That's a great sign. What you want to be looking for is, signs as you're coming down into low areas. Is there price rejection or price support? You have a red candle, green candle back here. This ratio 5.92, but it's black. That's just your normal order flow. There's nothing special about it. And you'll notice the market, it popped up in the next bar, then sold off some more. Then you got down to this new swing low, and look how it held, right? It's telling you there's price rejection down here. Sellers aren't interested in selling at these low prices anymore, and we start rallying back up. So this is a market that's going sideways, okay? Big moves often come out of markets that are trading sideways. And so what you want to look for is, signs that we're starting to come out of a move sideways. So you got a sign of price rejection towards the end of this sideways move, okay? Maybe you're not convinced. You pop up finally, you break out of this range that you've been in, but then you come back into it. Okay, so what does that mean? That means you're just going to trade sideways, or are we going to go higher? But in this bar here, second sign, you see a sign of price rejection. So that's, that's go time. That's, that, hey, traders are starting to reject these prices that we just have been trading in for quite a while, that, maybe we can get a nice move up, so you got to position yourself that if we start moving higher, you want to catch this trend, catch this move up. Okay, so here's one. It's an interesting one. Again, the market sometimes reveals itself to you, and it's a matter of you knowing what to look for and knowing, more importantly, taking advantage of it. So here's a market that is just, it's sort of coming down, sort of petered out here, and then we start rallying, okay? Notice a couple of things. Delta is negative delta right here, minus 675, minus 150, okay? But then boom, 257, all of a sudden you got aggressive buyers coming in. Then 1,054, again, aggressive buyers in control. And you're seeing price rejection. Sellers aren't interested in selling at these lower prices anymore. And in fact, you have net aggressive buyers. You have buying imbalances in the bars. You have higher points of controls. These point of controls are acting as support on this move up. You get up to the second level here. You got a ratio balance low, indicating price support, supportive buying coming in. Next bar, you've got very strong delta, positive 3,860. So buyers are definitely in control. You got signs of price rejection down here. Sellers aren't interested in selling where you had the support anymore. In fact, they're being aggressive. You see, you got 1, 2, 3, 4 aggressive imbalances, buying imbalances in there. So, if you didn't pick it up down here earlier, by the time you get to this sort of the second level up here, it should be a lot clearer to you. And what happens over the next 5 minutes? This is this one bar here from earlier, the ratio 4.33. It's right here. You see, boom, over the next 3 minutes, you get a 3-point move in the S&Ps. Granted, this was a week or two ago before this markets really started going berserko. But again, these are things that happen every day. This is a minute chart. It happens on minute-based charts. It happens on range-based charts. It happens on point figure charts. Most type of charts that you look at, you can use order flow with, as long as it's intraday. So once you understand in the markets and can determine possible turning points, you can look at other aspects of order flow to confirm the move. You look at point of control, you look at delta to help you with your trading decisions. Now, understanding order flow will help you control your risk in the markets, right? Especially these days. In this last week, it's been incredibly volatile, and traders have always struggled when it comes to placing stops. And one of the reasons why is they don't know where to place stops, so they just sometimes pick almost an arbitrary number out of the air, and use that as their stop level. And it's probably not a very smart level, but you ask yourself, where do you place your stops and why? What's the logic behind it? Did you do back testing and just sort of took an average level and say, okay, my stop should be here because out of 300 trades, it pulled back an average of 1.75 ticks. Okay, that's at least you got to stop, but it's probably not very prudent because there's going to be times where you could probably tighten your stop, and order flow is going to show you market generated places to hide your stop level, to hide behind, basically put your stop in, because if that level gets violated, you don't want to be in the trade anymore, basically. And again, it sort of comes down to understanding support and resistance based on the order flow. So we come down in here, we got this bottom here, okay? You got supportive buying, these are ratio bounds lows. And if you're getting long, your stop just goes right below this area. If you're buying it in here at say 46, 47, your stop is just here at 42, 41. You don't have to think, well, I got to have a 15-cent stop because my research has shown that. No, if it's going to violate this support area, chances are it's going to go lower and stop you out. So why should you risk 15 ticks when you could just risk 7 or 8 ticks? If you understand where there's support or resistance in the market based on what's happening in the order flow, then again, you could tighten up your stops. Perfect example down here. This is what, I don't know what this is, euro currency. And you got support down here at 70, 77. Say you're getting long somewhere in here at 80, 81, 82. Your stop is just below 77. It's 76, 77, and you don't have to say, well, I got to have a 10-tick stop or a 15-tick stop. No, if it violates your support area, you shouldn't still be in the trade. Again, that's coming down to understanding what's happening in the market and where you can safely hide behind, right? Because again, if it violates your support or resistance level, the whole reason for being in the trade is invalidated, and you should not still be in that trade. And here you got sort of this high forming. You got price resistance in these two bars. And if you're getting short, again, that's where you'll be hiding behind these areas up in here. You don't have to have a stop that's off the chart up here. You're getting short at 64.06. Your stop is just right behind here, 64.16. You don't have to have it up at 64.20. You can have tighter tighter stop placements, which ultimately will protect you more. Again, especially in markets like this past week, you gotta have bullets. You gotta keep bullets to fight another day. If you're placing very wide stops, you're taking on more risk than you should. So the last part I want to talk about is understanding trading, that there's more to trading than just having a successful strategy. Strategy is important. Yes, you have to approach the markets with a trading plan and understand what's going on in the markets. But again, just having a strategy is an important part, but it's only one part of the trading puzzle. And again, if there's one thing we can all agree on that we don't like about trading, it's risk. I don't want you to take risks when you're trading. I see risks and I run away, especially in the last few days. Incredible volatility in the markets. This is actually from a day or two ago, but you can see, the Russian ruble crisis, that was back in the 90s, late 90s, credit crisis in 2008 and 2012, I think it was. The U.S. was downgraded from AAA to AA plus, and you can see how the volatility has spiked up earlier this week. And again, it's coming from a very low area. Some of these higher these spikes weren't as low as it was. Even the financial crisis, we're already poking up above 20. Russian ruble, I mean, we had this Asian crisis before that, so we still hadn't fully recovered. But this one, I think people are expecting a pullback, but with the markets being at these very high levels, it just made it the drop look more than I honestly I think it really was. it's one of those things where, in percentage-wise, it's not even in the top 5. Especially today, we're down another how many 100 points as well. So, but you got to ask yourself, before you start trading, is trading for you? For some people it is, and for others it's not. Okay, it's a matter of understanding yourself as a person, and you have to ask yourself, are you willing to take action? Can you make decisions? Do you want to be your own boss? You can work your own hours. Having a job is good because you're going to have a regular paycheck. In trading, you don't have a regular paycheck, and in fact, sometimes you lose. So instead of money coming in, you got money going out, and sometimes it never comes back. Can you handle rejection? Basically, there's times you're going to be wrong in the market. There's a lot of stress involved with that, and do losing trades affect your psychology? Those are questions everyone has to ask themselves before they commit to trading. Now, order flow trading, is one step beyond trading. You have to ask yourself, do you think it's for you? Are you willing to put in time and effort to learn? If you're just going to be a tire kicker and try it for a day or two, then no, it's probably not going to work for you. But if you want to learn how to trade and understand the markets, then order flow is definitely something that you want to do. Again, remember, 90% of traders, new traders, will lose their account in the first year. And I'm not saying just lose their account, I mean blow it up. And in some cases, people got to put in more money to make a margin call. But why do you think that is? Why? Ask yourself, why do you want to keep trading the same way that the majority of losing traders do? I mean, that's why you should look for someone that's successful in the markets. Shadow them, follow them, learn from them, because that's how you're going to learn to get better. You're not going to become a better trader by following people that are consistently losing money or blowing up trading accounts. Going to the trading forums and reading people's trading journals. You read some of these people's trading journals online, and within a week they're doing something completely different from what they originally started doing. That's not trading. That's just shooting from the hip. And what order flow analysis allows you to do is plan for a trade. Too many traders trade without a plan or a poorly conceived plan. But if you're serious about your trading, you have to approach it as a business, and you wouldn't run your business without a plan. You could, but you probably would not be very successful at it, and you probably close your business down. Whether you run a pizza shop or run a limousine service, trading is the same way. You have to have a plan, and there's just no other way around it. Now, when I consider a trade, I go through a process to determine exactly what I'm trying to do and how I'll react regardless of what may happen in the market. I put on a trade, I know exactly where I'm going to be looking to get out. I'll be looking whether it's taking a profit or whether it's taking a loss. Now, every trader has to develop their own trading plan based on their own risk tolerance, their goals, their financial situation, whatever factors come into play in your own individual situation. Maybe you can't trade 8 hours a day. Maybe you can only trade at certain times of the day. Okay, you have to factor that into your trading plan. I mean, that's when I talk about it's more to having a strategy to be successful. This is what I'm talking about. Now, what I've presented here is what I've developed for myself. I hope you can find things you can use and things you can modify and adapt for your own trading. Now, I'm not saying you have to follow what I say just because I say it. Everything I said, anything in trading that you come across from me or elsewhere, you have to decide if it's going to help you, and if not, just reject it. Okay, fine. If order flow is not for you, fine. Find something that resonates with you, and add it to your trading to help you become more successful. So hopefully by now you can see how powerful order flow analysis is, and ask yourself, do you think it's easy or difficult? Keep it simple. And order flow is about as simple as it gets. It's taking what's happening in the market and putting it into an easy to read format so you can understand it. So if you found this presentation helpful, and I hope you did, I got a special package for you. It's called the Order Flows Trader Software Package. And for me, I think it's the easiest and fastest way to trade with order flow. You're gonna choose consistency and control of your trading. When you're trading, you don't want to be trading, shooting from the left side, from the right side, because I got a feeling on this. No, you should have some order, no pun intended, to your trading. Some structure to your trading, so you know why you're taking this trades. The decision process, and you understand it. Being a good trader is not about being special. It's not about having luck. No, is there luck in trading? Of course there is. There's times where market goes right to my take profit level, starts trading, but where I am in the queue, I'm not in the front. I'm in the back and it trades there, but it doesn't trade enough quantity to fill me, and then the market sells off. And I either break even or take a small profit or take a small loss. That's about as how luck influences in trading. I don't believe that you could be walking around lucky and everything you do touches the gold. But there may be times where it seems like you can't do anything wrong. But once you understand what's happening in the market just makes sense. You just understand it. And again, you don't have to spend 10,000 hours of screen time trying to learn how to trade. You're taking in unnecessary risks, and most importantly, wasting your money on shiny objects, right? You should be learning how to trade and trading properly. So what I got for you, I've got the Order Flows Trader software package, which runs on NinjaTrader 7 or NinjaTrader 8, and it's the volume footprint chart with an additional 4 pre-programmed order flow indicators. I talked about 2 of them. Actually, just one of them, the ratio bounds high, ratio bounds low. There's others I just don't have time to get into today. So your charts can, you get up and running, and so you can look at a chart and not have to spend time trying to mess around, trying to get your chart looking, how you would like it to look. So that's what you get. But I realize, having the software is one thing. Okay, you have to understand how to use it. You got to know what to look for. So I don't just give you software and say, hey, go on your way. I still give you a lot of education so you can understand how to trade with order flow. And one of the things that I'll give you today as a special is the Order Flows trading course. And I normally sell it for $297. It's 15 hours of instruction on trading order flow, and you're going to get it for free. I'm going to include it in the package. So basically you'll understand what to look for, know what to look for. And special thing is I'll also give you access to my Order Flows Inner Circle, which is right now it's over 55 videos on advanced order flow analysis and additional indicators on reading order flow. These are my proprietary knowledge and tools, right? I've been recording these videos so that maybe one day if my children decide that they want to start trading, at least I'll have this stuff recorded for them that they can learn from. And the access to this Inner Circle is closed, but normally when I open it up, it's normally about $1,000. I open it up maybe once or twice a year. And I said, any new indicators are included in there. So you get all that as well for free. So what you're going to get is the Order Flows Trader software, which is normally $900, the Order Flow trading course, and access to the Inner Circle, which is, add all this up. Normally it's $2,193 if you were to buy it separately. But because of investor inspiration, I'm giving a special offer, just a one-time payment of $1,250. So you go to orderflows.com/all-in. There's no more monthly payments or any other payments you have to make. You get everything, literally everything that I've created, for this one price. Now, again, if you don't believe me, other people have got it. They've been posting nice things online. Here's this Sheila writes, your Order Flows Trader software is remarkable, helpful because I can clearly see now what's happening in the market, like who's in control of the market. To be honest, I don't think I can ever afford to use any other trading chart aside from your Order Flows Trader chart. Now, put it in perspective. What else can you spend that type of money on? You could buy an iPhone X, and in 2 years you could buy another one because these phones tend to last only a year or two. Yeah, that's great. I have an iPhone. It's nice, but it's not going to do anything for me. It's just going to let me surf the internet, make phone calls, chat with my wife and kids. But what would you rather do? Would you rather have a nice phone, or would you rather learn something? Learn a skill, learn how to trade. So go to orderflows.com/all-in, and if you do that, it takes you to this page. You just scroll down to the bottom. It said click the button. I'm all in. Takes you to PayPal. Again, it's handled by PayPal. I don't get your credit card information. I don't want it. And hopefully, why should you join Order Flows is because you can see the power of order flow analysis and how it can change your trading. You want to understand what's happening in the markets. You're excited to find low-risk trading opportunities, and more importantly, you want a life of freedom and fulfillment. You want a life to live on your terms. When you want to go on vacation, you just step away from the computer screen. You just turn off the computer, and you could just go out there and enjoy life. You don't have to say, oh, I got to work tomorrow. I can't go out tonight. No, like that. When you're trading for a living, you have control of your life on when you want to take off, when you want to spend time with your family, when you want to go on vacation. And working for somebody, working for a company. You don't have that freedom. Now, if you stuck around, you get my book, Trading Order Flow. Just go to the link below, orderflows.com/book.html, and it will take you to a page. You got to enter your email. Okay, that's fine. And just so when I put out, do webinars and stuff, I will email you on it. So that's the only thing. And so thank you everyone for attending. Again, go to orderflows.com/allin.html.